Hello and welcome to the accounting channel. My name is Colin and today I want to do a quick video showing you how to predict and measure business failure using a few simple models, both using figures and using qualitative information. The four most obvious factors in predicting company failure usually come from industrial conditions, company weaknesses, management weaknesses and financial weaknesses. But there are two main models which predict corporate failure or business failure with 70 to 80% accuracy. That's the Altman Z-Score and the Argenti A-score. One involves numerical analysis and the other involves quality analysis. The Z-score in the example I will show in the Excel spreadsheet next is adapted for company failure, small company failure, whereas the original Z-score originally was intended for listed manufacturing companies. So if you'd like to prevent and predict company failure of your business, use my spreadsheet, which I'll show you how to use right now. Okay, so the first one is the Z-score for private companies, which was developed by Altman and has been adopted here for use in smaller companies that aren't listed or aren't involved in manufacturing. The Z-score, if it was written as an equation, would look like this, and which obviously makes no sense until you break it down. To be specific, you need these 5 inputs which are based on various ratios from your balance sheet and profit and loss. So the first one is earnings before interest and tax divided by total assets. The second is net sales divided by total assets. The third is the book value of equity over total liabilities. If this was a listed company, you would use the market value of equity. The fourth is a working capital divided by total assets, and the fifth is retained earnings divided by total assets. The weighting is important because some of these ratios are more important than others. Obviously this one's more important than the book value of equity in terms of dealing with how safe your company is. So a score greater than 2.9 means your company is deemed financially safe. Between 1.23 and 2.89 means you still have time to turn it around and take action to prevent company failure. And a score of 1.23 below it indicates a high probability of failure, so it might be too late to do anything about it. Now I've scripted a sample balance sheet and a sample profit and loss so that you kind of know where to plug in figures. Obviously the most important ones in this case, earnings before interest and tax divided by total assets. So we have here earnings before interest and tax is 8,000, comes from your profit and loss before interest and tax. So it's just after revenue minus gross costs minus total expenses. Your total assets comes from your balance sheet, and it is this portion which balances with the total equities and liabilities section. If you're unsure of any of these or how to get any of these figures, either just comment below and I'll try and explain to you, or ask your accountant to basically plug these figures into the Z-score. Your net sales will be your revenue for the year. Over total assets again is still the same figure, 70,000. The book value of your equity is what it says on your book. It's self-explanatory. In this case it's 20,000 minus your retained earnings of 19.9, so 100. So that's £100 worth of shares. X4 is working capital being current assets minus current liabilities. That's the formula there. And retained earnings over total assets gives you X5. Retained earnings can be found once again on the profit and loss, on the balance sheet here, which is your accumulated profit since the day you opened, and over your total assets again, which is 70,000. This is the weighting, and this is the formula that calculates that, and basically this adds it up. So it's very simple. In this fictional company, I've got a score of 1.31, which means I can do some things to turn it around and bring this result higher. It'd be best to work on this. So if I next year increase my earnings before interest and tax, I would definitely get a higher result, probably 3 times as much. So if my revenue was 80,000 instead of 50,000, my score would still be 1.31, unfortunately. Okay, so had my revenue been higher for the year, let's say it was higher by another 50,000, so we changed it to 100,000, my Z-score would improve dramatically. But unfortunately it was only 50,000, which means I need to do something else to turn this around. Next, I'd like to go on to the A-score, which is more qualitative. It looks at 3 things: defects, mistakes made, and symptoms of failure. It is important to be aware that this is very highly subjective and open to judgment, so the score can be quite difficult to obtain. It's best to get the opinions of 2 or 3 people within your company, not just score this yourself. Especially if you happen to be the autocratic managing director, then I can see yourself giving yourself a very small score. So whereas the objective of the Z-score is to score as highly as possible in order to obtain a good result, the objective of the A-score is to score as low as possible. A score of below 26 is deemed good, and above 26 is deemed not very good, and you need to turn it around. Defects of the company typically include an autocratic managing director, passive upper management, lack of balance of skills in the management team, like your typical departments, financial, legal, marketing, a weak finance director, slow or poor response to change. If you score highly in these, you're going to score highly at the end. Other defects include accounting deficiencies, so there's no budgets being done, there's no cash flow, there's no costing system. Obviously, these are very big deficiencies which will lead you to corporate failure. The next stage happens because of mistakes that are made. So if you've got too high of a gearing, so the company has too much debt to its share value, or if it's over trading, which means that it can't actually actively service the customers it has, or if one big project, it can be external or internal, fails and threatens to bring the company down, these all are added to the score because these mistakes are quite detrimental to the company's well-being. And if you get to a stage where you're scoring in any of these categories, the symptoms of failure, it's probably already too late. So the financial signs, if your Z-score is too low, that's a financial sign that there's a symptom of failure. If there is creative accounting being done, like if your accountant is not valuing depreciation properly to increase the profit level, for instance. There are other non-financial signs, including frozen management salaries, or you can't pay your purchases, or your staff are quitting all the time. And then terminal signs, it's when it's so obvious you're going to fail that you don't even need this anyway. You just know you're going to fail. So that's it. That's the A-score and that's the Z-score. If you'd like this spreadsheet, please email me. I'll leave the email in the comment section below, or visit firstaccounts.ie to get your to get an opinion on predicting and measuring company failure.